Let's move on to the balance sheet. All right, as I mentioned on the income statement, it covers its money coming in and going out over a period of time. Balance sheet is something completely different, as you can imagine. The balance sheet summarizes the company's assets, liabilities, and owner's equity, or retained earnings, shareholders' equity, at a specific period of time. Now, let me pause a second to define owner's equity. Again, it depends on the type of business. Owner's equity, retained earnings, shareholders' equity are all referring to the same equity that's going into a business. So it depends on the legal structure, it depends on the type of business as to how that's actually referred to. Obviously, if you're a sole proprietorship, it may be referred to as owner's equity, and then from there on is referred to as retained earnings. Shareholders' equity probably wouldn't apply. But if you have more than one person that's owning a business, then you might have shareholders' equity. So again, don't get hung up on the terminology. They all mean the same. So, but it's company's assets, liabilities, and owner's equity at a specific period of time. So you can think about it from your own personal aspect. All right, I get paid once every 2 weeks. So I have income that's coming in, get paid every other Friday, and I have things that I'm paying over the course of a whole month. I have my mortgage, I've got utilities, I have trash, I have dog food, I have cat food, I have all those things that I pay for over the course of a month. So my paycheck is coming in on the income statement and all my expenses are going out on my income statement. But my balance sheet is showing the amount of money that I have in my bank account as of today, because it's going to change. I mean, I looked at it this morning and it's going to change tonight when some of the things that I set to pay clear the bank. So it's a specific period of time. Now, a balance sheet shows what a company owns and owes, as well as the amount invested by the shareholders or owners. So let's move on a little bit. The formula for balance sheet, and this is where the hang-up comes in and where the challenge comes in. The formula is assets equals liabilities plus owner's equity. And again, owner's equity can be shareholders' equity, retained earnings. So it's assets equals liabilities plus owner's equity, and they must equal out. I put on the side of the screen a scale, meaning a scale has to be in balance or something's wrong. So a company has to pay for all things it has, those are assets, by either borrowing money, liabilities, or getting it from investors or owner's equity. So if you're going to buy something, if you're going to buy a new car, it becomes an asset. So to buy that asset, you've either got to pay cash or you got to go borrow the money, and it might be a combination of the two. So the asset, the car is on the asset, that's one side, and then the loan plus the money I put down, that's the other side. So if my car is $20,000, it's on the left side, and then it's $5,000 down and $15,000 in loan. It all equals out. So again, that's the biggest challenge to this. Now, so I've got on the screen now one, which as an example, and again, this one can be grouped based on what works for you. In this particular case, it's as of December 15th, 2017. And the assets are always listed first. So you've got current assets. Now, current assets are things that you can turn into cash within 1 year or less. Well, checking, savings, that's actual cash. You can go to the bank anytime you want. And then you have accounts receivable. Typically, accounts receivable are paid within a year, you hope. I mean, it could be a little challenge in today's environment, but even then, you would think you would get paid within a year. But there are things that once you get paid, they're actually cash. And then you have other current assets, and they could be things like CDs, securities, anything along in that line. They might also be, if you've got prepaid insurance that you could cash in and get money for right away, get a refund on, they might also be a current asset. It just depends. Okay, so you got current assets, and then you have fixed assets. Now, in the case of my car scenario, this would probably be under the other asset category of listed here. The fixed asset would be anything that I bought. Think leasehold improvements, that's a good idea. That's a good example of fixed asset. You're leasing space and you do some major improvements to it. You put in something that stays with the facility, with the location, maybe an HVAC system. That would be a fixed asset, something that is depreciable item over 3 to 30 years. It just depends on the fixed asset. So, but again, it's something that you're not going to be able to just sell separately and get money for without considerable work to do it. So once you have all that together, you add up all your assets. And again, you can break these down into the way that works for you. Some people break down their fixed assets and they list individual fixed assets and they list individual other assets. It just depends on what works for you. But you'll see the highlighted portions here. Total assets is $635,000 and some cents. Total liabilities and equity is the same exact total to the penny. So let's move on to liabilities. You got assets at the top, then you list liabilities, and you got current liabilities. Just like on current assets, you're listing those assets that are cash. You can turn to cash within a year. You're doing the same thing on liabilities. You're listing first the things that you're going to pay off within a year. So current liabilities, you got accounts payable. Normally, you're going to have to pay something within a year. So you list those. Credit cards, well, hopefully those are considered a current asset because you have to make a payment on it every month. So they're usually thinking you're not going to carry those on from over the course of a year without converting it to a long-term liability. And then you have other current liabilities. Those might be, sometimes they'll list a line of credit because a line of credit usually expires within a year. Converts to a long-term liability, which would be my mortgage. You know, it's 30-year mortgage. Maybe you're getting an SBA loan now in these times that you're not going to pay back for, you know, an extended period of time, 10, 20 years. So that would be a long-term liability. So current is within a year, long-term is longer than a year. And again, you can list these however you want, whatever works for you. Next is equity. Okay, so let's talk a second about equity. One of the biggest questions I get on a balance sheet is, I know my assets, I know my liabilities, I have no idea what my equity is. Well, the way to figure it out is if you know assets and you know liabilities and you know assets equals liabilities plus owner's equity, if you take assets minus liabilities, that's going to be your owner's equity. Owner's equity is things that are carried over from year to year to year. It's the money you put into your business to keep it operating and you haven't spent. And so when you're completing one of these, if you don't know for sure what it is, but you're positive of your assets and you're positive of your liabilities, you're going to subtract it out and stick the rest of it in owner's equity going forward. Now, obviously, you got accounting you're going into here. We're not going to go down that rabbit hole, but if you have an accountant, they're checking to make sure this equity is true. So way to think about it is that car that I bought the car for $20,000 and I had a $10,000 loan. The rest of that was my money put into it. So that's going to go in the equity column, you know, because it's my money, it's equity. So at the end, you got to balance, and that's what's highlighted, the two sides balance. Okay, any questions on this, Jack, before I move forward?
Yeah, we've got just one quick question. So in the context of when banks look at this, you know, your balance sheet, and they see that you have a considerable amount of equity, how is that going to affect the determination of a loan?
Well, that's a really good question. And this is going to come into play in the second part of this workshop when I start talking about ratios. But as a rule of thumb, believe it or not, I've seen negative equity, which means they owe more, their liabilities are, that number's bigger than their total assets. And so that means that there is no equity, that the owner is constantly putting money into this business, which is causing it to go negative. That is a red sign for a bank because they're looking at, they don't want your liabilities to be higher than your assets. And we'll talk about how to figure that out, you know, in the next section here. But generally they're looking, they want some equity because that's equity in the business. It means that you know, there's been money left over between the two because you haven't bought all of your assets with loans. You've actually put money into it, and they do, wow, okay, that's great. But if it becomes a negative situation where you're pulling more money out of it than what you're putting into it, then it's a bad thing. So we're going to talk about that in a second. But generally speaking, having a number in equity is a good thing on this, because that means the business is being managed correctly, and that the liabilities are lower than the assets. So that clear enough for now till we move on to the next part?
Yeah, it appears so. Thank you.
Okay, so remember, a balance sheet is what you own and owe. An income statement is the money that comes in and goes out of a business. All right, cash flow statement. This is the one that, in my opinion, tends to, if anything is going to cause a business owner to bang their head against the wall and want to put their head in the sand, it is the cash flow statement. And believe me, I feel your pain, because these are a little bit trickier to understand. A cash flow statement provides data regarding all cash inflows and a company receives, as well as all cash flows that pay for business activities. Again, this one is during a given period of time. It is very, very difficult to do a cash flow statement as of a specific period of time, because you're looking at what, the impact of your activities, what impact does it have on cash? So a cash flow statement shows how much money the company has on hand and how it is managing that cash. It's important because income statements may not reflect the changes in cash position. All right, so here's an example of that to help illustrate that. A sale may be recorded as income if a company has agreed to a contract, even if no money has actually changed hands yet. In this case, actual cash will not equal income on an income statement. So I sell, I always pick on Jack on this because he's just a good guy. He lets me do that. Jack buys something from me, and he buys a widget that costs $500,000, and he's going to pay me for that later. So as soon as I make that sale to him on my income statement, I'm recording that widget sale, that $500,000. But it's going to become an accounts receivable because he hasn't paid me yet. So on the income statement, it shows $500,000. On the balance sheet, it shows accounts receivable is $500,000. But my cash is not even affected yet because he hasn't paid me for it. So until he pays me for it, there is no cash to record here. So that's the difference between the cash flow. You got it on the income statement, it's recorded the minute I make the sale. On the balance sheet, it's recorded the minute I make the sale. The cash flow, it is not recorded at all until I actually get cash for this. And so that's kind of the differentiating factor here. So when you're doing a cash flow statement, a company can be profitable in the eyes of an accountant, but still have trouble paying its bills. Because you'll look at my income statement, now $500,000 is out there. You go, woohoo, great, I had a great day. My balance sheet says, wow, that's an accounts receivable. You could get paid that $500,000 within 30 days.